Hello and welcome to our webcast, Raise Money Without Losing Control of Your Business. We're pleased that you've joined us today. And before we begin, I'm going to play our housekeeping video, which will cover information on CPE and how to use your console.
Welcome, and thanks for joining. We're pleased to present our continuing professional education webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. Today's session offers 1 CPE credit. To receive credit, you must meet the National Association of State Boards of Accountancy requirements. You must attend at least 50 minutes of the session and respond to at least 75% of polling questions. To participate in the polls, please check the button next to your answer within the slide window and click Submit. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry if you can't download your CPE certificate today. We'll email you a copy in 2 weeks. If attending this webcast in a group, you must complete our group CPE attendance sheet, available in our Slide Deck and Handouts widget to receive credit. Please have all group members sign it and send only 1 sheet per group. CPE credit can only be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right, now that we have our housekeeping items out of the way, I'm going to hand it off to Gassen to get us started.
Thank you, Amy. Hello, everyone. Welcome to our webcast. My name is Gassen Mosbahi. I'm a partner in the M&A transaction group at Moss Adams. I also lead our food, beverage, and agriculture consulting group within the firm. Over my 15-year tenure in the M&A space, I've been involved in more than 300 transactions, both on the buy side and sell side. Today's webcast focuses on a critical topic in the ever-evolving food and agriculture industry, raising money without losing control of your business. We have brought together esteemed industry experts who will share their insights and experiences on how entrepreneurs, business owners, and management teams can secure the necessary capital while maintaining control of their businesses. As we all know, in the dynamic and vital world of food and agriculture space, securing funding is often associated and essential for growth, innovation, and maintaining a competitive edge. However, business owners and farmers face a significant challenge when it comes to raising capital without surrendering the control of their operations. Losing control can mean compromising their vision, decision-making power, and ultimately the ability to shape the future of their enterprises. So to provide a diverse perspective on the capital raising process, we have invited 2 speakers from different roles within the industry. Hopefully, we explore with them the viewpoints from 2 perspectives, the investment banking perspective and then the private equity perspective. Our first speaker is Scott Porter, a manager director at Cascadia Capital, a middle market investment bank with offices in multiple states, with a focus on client relationship in the food and ag sectors. Scott's expertise lies in M&A, recapitalizations, restructurings, and private placements. His deep understanding of the entire farm-to-table value chain, including current crop dynamics and shifting consumer preferences, informs his guidance and advice in leading the transactions he's involved in. Scott's holistic perspectives add immense value to his role within Cascadia. Our second speaker is Patrick Bowe, a VP of Business Development at AGR Partners, a middle market private equity firm based in Davis, California. Pat joined AGR in 2022 and concentrates on developing new investment opportunities and supporting the investment activities of the firm. Pat has prior experience as the VP of Commercializations at Heartside Food Solutions and also in corporate development at Cargill's bioindustrial business. His aerial work at Deloitte Consulting in strategy and operation further enhances his expertise. So together, our speakers will provide invaluable insights into the strategies, challenges, and best practices associated with raising capital without, of course, losing the majority in controlling the business. We are thrilled to have them join us today and share their expertise. So without further ado, let's dive into this engaging discussion and hopefully gain a comprehensive understanding of how business owners, management teams can secure funding in these times. So obviously, there are different ways an organization can raise money and access capital. There's multiple alternatives, schemes that investors use in providing that level of financing. And it could vary by the size of the company, the industry, the stage where they're at, a lot of things, a lot of variables. And hopefully throughout the discussion, we can achieve certain objectives, by listing some of the different types of the financing option that could be available for parties to do a deal. Also examine some of the various investors in the marketplace and distinguish the activities that allow you to keep control of your operations. So before we get into this, we just wanted to get an idea from the audience on where they see or if they see a transaction in the near future, whether within the next 12 months, 24 months, or beyond that. So if you don't mind, you guys try to answer that first polling question, and then we're going to have another one right after that. So I'll give us a few seconds to do that before proceeding with the next one. I think we have about 66% submitted, 70%. We'll give it a few seconds. Good. So this is what we're seeing right now. Almost about half, or 45%, are not considering transaction, and the other half is considering transaction. 30% or so are within the next 12 months. So somewhat consistent to what we've seen as well when we're discussing these matters with our clients as well. The next question is, in the event you want to enter into a deal, what is your preferred sales structure? Do you want to sell 100%? Are you looking for 50 to 90% investment? Or you want to keep control pretty much of your business and only allow less than 50% of investment contribution? So let's please go ahead and submit your choices. All right. So the vast majority, 62% or so, prefer not to give more than 50% versus the other half, or the other 30%, 38% or so are, more open to 100% or anywhere between 50 to 99%. Pretty good. So I guess with that, I'll turn it over to Scott, who will give us an update on the state of the economy and M&A market so far in 2023. Scott.
Yeah, thanks, Gassen. Appreciate it, and appreciate the introduction. Just as a refresh for everyone on the phone, I'm a managing director at Cascadia Capital. I help lead our firm's food, beverage, and agribusiness practice. We work generally with private, family-held businesses, multi-generational businesses to help do three things. We help businesses think through M&A transactions, so either looking to make an acquisition or looking to sell your business. The second thing we do is help companies look to raise capital, and that can be debt, that can be equity, or something in between, and that's really what we're going to spend some time focusing on and talking about today. And then the last thing we do, I'll put in kind of the everything else bucket, which is a combination of some valuations, fairness opinions in general, strategic advisory, as well as making some direct investments into companies also. So as Gassen mentioned, what I specifically want to focus on today is twofold. First, what is the market like? Is now a good time or the right time to look at considering a transaction, whether that's a minority transaction or a controlled transaction? And then secondly, when you are considering doing something, what are your options and what are the considerations of those options? So those are the two things I intend to focus on. As a reminder, there is a Q&A section below. Feel free, please do ask questions along the way. We can see them and we'll answer them through a Q&A at the end as well. So let's start on the first slide here. So the question we get asked often right now in particular is now a good time to raise money? If you asked me 2 years ago, 3 years ago, the answer would have been very simple. And that answer would have been yes, now is a great time to raise money. And it would have been true for just about every business, every company, no matter the sector you're in. The answer today is it depends. It's much more nuanced, and we'll talk about more about what that means and why here as we go. So let's talk first about 2022. We saw a significant amount of macro challenges here in 2022. The CPI was at record highs. Inflation obviously skyrocketed last year in 2022. As a result, the Fed raised federal funds rates, so interest rates went high and to the highest levels that we've seen since 2007. You had the war in Ukraine. You had that emerge. You had ongoing and fairly significant supply chain disruptions. All of this led to stock market volatility that we saw, and just generally a lot of macroeconomic factors that created broader uncertainty in the markets, which had an impact both on companies' abilities to raise money and also companies' ability to raise money at high valuations. So that's kind of the backdrop, the lens of the macro environment that we were entering into this year. So one would expect that the transaction volume dropped significantly. And when you look at it relative to 2021, which was a record of any year we've ever experienced, we did see a drop in activity last year. However, if you go back 5, 10, 15 years, what you'll see is 2022 and the first quarter of 2023 specifically was actually still, when you look at a longer term time horizon, was still a very active environment. And so I think the question is why? Why, in light of all of these macro uncertainties, macro challenges, why did we still see a lot of activity? And the answer is a fewfold, but one significant reason is private equity. Private equity today continues to drive a significant amount of transactions in today's current market. And I'm going to speak a little bit as a generalist, or a bit generally, this is what I'm about to say is not true for every private equity firm. And Pat, who's on the line, represents one private equity firm. And Pat, feel free to chime in because I know you guys are very different in some ways. But generally speaking, across the market, what we're seeing right now is that private equity over the last few years has raised record amounts of capital. And for most private equity firms, when they raise money, it's a use it or lose it type of model. Private equity firms generally have an 8 to 10 year fund life cycle. So if I'm a private equity firm and I go and raise 500 million, I have 8 to 10 years to take that capital, invest that capital, grow that capital, and then give that capital back to investors. In order to hit that timeline, what private equity funds generally look to do is when they raise money, they want to try and put it to work in the next 24 to 36 months in order to hit that timeline. And so for private equity, if they've raised a fund, if they've raised money, they need to put that money to work in the next 2 to 3 years. Generally speaking, again, I'm generalizing, but generally speaking, regardless of the macro conditions. So when I think about private equity investing money, it's not a matter of do we invest in light of the macro conditions. It's more a matter of where do we invest in light of the macro conditions. And so what you'll see here in this top chart is this represents the amount of what we call dry powder. And when we say dry powder, it's the amount of capital that has been raised by private equity funds that has not yet been invested. And what you'll see is in 2006, you had 326 billion of dry powder. Today, you have almost 800 billion of dry powder that's out there. So almost triple the amount of what we had back in 2006. That level of high dry powder is creating a dynamic where there's still a lot of capital that is looking to invest and be invested into private family-held companies. And what you'll see below as a result is the green line here represents the amount of deal activity that we have seen in the market on a year in and year out basis. And you'll see if you go back all the way to 2009, 2022 was the second highest year on record, just after 2021, which was a record. And so deals continue to get done. We have record amounts of capital that continue to be out there looking for places to park their money. And so when we think about that dynamic, it becomes, again, a matter of where do private equity firms invest capital? And so as they look at a potential recession impending, as they look at a lot of cyclicality, a lot of market challenges, investors are saying, where should we park our money? Food, bev, and ag continues to be one of those sectors where investors are looking and saying, this is a great place to invest in light of the macro circumstances. And why is that? Generally speaking, when we have periods of high inflation, commodities and hard assets tend to perform very well. Food and ag fits that quite well. When we have periods of going through a recession or periods of cyclicality, this thesis of everybody needs to eat tends to remain very true. And so investors are looking historically and saying, when we go through these times of uncertainty, food, bev, and ag tends to perform very well. And so what we're seeing right now is more investors today trying to invest and looking to invest in the food, bev, and ag sector than ever before. And what that is doing is creating supply-demand imbalances. There is now more capital in search of fewer good companies in the right sectors than there have ever been before. And that actually, for those select companies, is keeping valuations quite high and frankly at peak highs. Now, that is not the truth for everyone. So there are other sectors that are, in light of these macro challenges, being hit relatively hard, both from an interest level and therefore a valuation perspective. So I'll look at consumer discretionary, so consumer retail, apparel, anything that is discretionary on the consumer tends to be a segment of the supply chain that is having challenges both in garnering and attracting investor interest, but also in raising capital at peak valuations. And so I think today, again, going back to is now the right time to raise capital? The answer is it depends. It depends on the sector that you're in and the area of that sector that you play. It used to be historically, going to this next slide, that strategics. And when we think of strategics, we think of companies that are in the industry, not financial investors like private equity firms. It used to be that strategics would pay generally the highest price in transactions. And what we are looking at here is valuations. And this is a chart expressing valuations on a enterprise value basis to a multiple of EBITDA. So investors think in terms of EBITDA and a multiple of that EBITDA in getting to a total valuation for your business. These numbers represent that multiple of EBITDA. And what you'll see is a trend of, over time, large corporate strategics paying less and less as that macro environment has become more uncertain. The same is true to a much lesser degree for private equity. And again, it goes back to that theme. Private equity has capital that they need to put to work. It's not a matter of if, but where they invest. And so what we are seeing today is actually, generally speaking, we're seeing financial investors ascribing higher valuations more often than not to companies than strategic investors. And again, it goes back to private equity firms wanting to put that money to work. And so I would summarize the macro environment as, if you are a company going to raise capital, if you are in the right industry, an industry that is food, bev, and ag, or healthcare, something that tends to perform well in uncertain times, now is actually a really great time to maximize valuation in the market. If you're a company that is not necessarily in those sectors, it may not be a bad time also to raise capital for the following reason. We're actually seeing companies raise capital, choosing to do it at lower valuations, but with the idea and thesis that their competitors, the companies that they could go acquire, now have lower valuations. And so we're seeing a lot of businesses take on capital to take advantage of lower valuations in the market so that they can go and make acquisitions. And we'll talk about that here in a minute as well. So that's just the quick 5-minute update on what we're seeing in the macro environment right now. What I want to talk about next is, if I'm a business owner, what are my options in light of that macro environment? I think before I do that, though, we have another polling question. And Gassen, I'll turn it over to you very quickly to go through that.
Thanks, Scott. Yeah, our next polling questions, again, we need these questions for CPE for reasons, but also to get kind of an idea on the where our audience is in terms of what we're discussing today. So the third question is, what are you most looking for in your outside capital? Cheapest rates, secure partnerships, or outside value at strategic perspectives? Please go ahead and submit your answers. Pretty good. Most of the respondents picked option 3, which is looking for outside value to add strategic perspectives. Pretty good. Scott, back to you.
Yeah, thank you, Gassen. That's a great segue, because I think the option we're going to talk about today focuses most on the segment of the market that really brings true value added and strategic perspective. So let's talk about that for a few minutes. When our firm is meeting with a business owner or a company, generally speaking, we look at the world of options in one of five categories or one of five buckets. Let's start from the left to the right. On the left-hand side, that results in the least amount of liquidity and the highest amount of ownership. On the right-hand side, as you move all the way to the right to full sale, that represents the least amount of ownership, but the most amount of liquidity. And we'll cover everything in between. But the left is status quo. And it's exactly what you would expect. Status quo is really all about maintaining what you are doing today, continuing to do what you are doing today without any additional capital, without any outside help, and without any investment. There are some times within your business and sometimes within the broader market where this may make the most sense. This allows you to maintain the maximum amount of future upside, meaning you retain 100% ownership in your business, but it does not allow you to realize either a liquidity event by taking chips off the table and raising money. It also does not allow you to bring capital into your business to bolster your balance sheet, whether that's for growth or reinvestment in your company. And so status quo is always an option at every company's disposal. And frankly, most companies on a day in and day out basis are operating in this status quo environment. As we move one step over, we have what we think of as a debt recapitalization. And think about this in a couple forms. You can go to your commercial lender down the road. Most companies have a commercial lender that they work with, and you can raise senior debt. When you raise senior debt, you're doing a few things. You are continuing to maintain control. You're obviously not giving up equity, but you are putting leverage on your balance sheet. And with more leverage on your balance sheet comes more risk. You have covenants that you need to maintain. You have cash repayments that you need to maintain, both in the form of principal and also in the form of amortization, or interest rates rather. And it often has limits on what you can use that capital for, both in terms of making acquisitions and also in terms of experiencing a liquidity event. Generally speaking, debt is a very good and very cheap form of capital, but within reason. Over leveraging your balance sheet with too much debt can be highly detrimental to companies. It also often comes without that strategic advice. So going back to the polling question, I think a lot of you here who answered that poll specifically said you want outside capital for that strategic advice and know-how and additional expertise around the table. Generally speaking, here you're getting less of that than, say, with a private equity investor or a strategic investor. There are also other forms of debt capital that we can talk about. It's not just your commercial lender, but there are other lenders, what we call junior or mezzanine lenders. This is effectively more expensive capital, but you will find that it is more aggressive, both in terms of the amount of capital they're willing to lend, but also more conservative in terms of covenants and the amount of restrictions that you have tied to that capital. There are a lot of reasons why companies may want to raise junior capital or mezzanine debt. It allows you to limit dilution or retain the most amount of equity while taking on more capital than, say, your commercial lender would provide. As we move one step over, you have what we think of as a minority equity investment. We generally think of this as investors coming into a business and bringing capital, either for a business owner to take out of the business and to take chips off the table, or to keep in the business for growth. That capital generally comes in the form of minority equity or an ownership level of less than 50%. The reason one may want to do this is because they do not want to give up control of their business, or maybe they believe, a business owner believes today is not the right time to maximize value, that if they had more capital beyond what their lender will give them or beyond what you're comfortable taking on in debt, if you have equity capital, you can supercharge growth opportunities within your business, make an acquisition, invest in a new facility, a new product line, and with that, you can increase your valuation over time such that when you ultimately sell, you can sell at a higher valuation than you would have without taking capital on. The next one is a majority equity investment. Think of this as an equity investor investing in more than 50% of the business. And the last is full sale. You sell your entire business 100% and retain zero ownership. What we are specifically focusing on today are the buckets highlighted in green, a debt recapitalization and a minority equity investment. As I mentioned earlier, not all equity or capital is created equal. You have your senior debt or your lender, you have the junior debt that I talked about earlier, and you also have different types of equity. You have preferred equity and common equity. Preferred equity comes with some advantages and disadvantages, but think of preferred equity, think of a capital stack in terms of who gets paid back first. So if I'm selling my business, a senior lender will always get their money back first, then a junior lender, and then preferred equity, and then common equity. What's important to understand is some investors may look to come in this preferred equity form, which would be different than yours. Some will look to come in the form of common equity, and there are benefits to both. There are considerations to both. We can talk about that as well, but we'll send this. A few of you have asked since we've been talking if we can send these slides. We can send these slides, and you'll have as a read behind or leave behind a lot of the advantages and disadvantages of these types of capital. Lastly, not all investors are created equal. You have different types of investors that come again with advantages and disadvantages or considerations. When we think of the world of investors, you have corporate or strategic investors. These are the companies that are already in the industry. You have private equity investors, and there are a lot of different types of private equity investors, some that specialize in minority, some that specialize in majority, some that look at a time horizon of 3 to 5 years, others that look at 10 plus years. And then lastly, you have family office. And think of family office as large, wealthy individuals that are reinvesting their capital. The last thing I just wanted to quickly talk about before I pass this over to Pat to talk specifically about how they invest and think about this from an investor perspective, I wanted to talk through 2 quick case studies. The first is a company called AgriVision. We represented this past year a company, AgriVision, which is a vertically integrated producer of blueberries and superfoods. The company wanted to raise a significant amount of capital to reinvest in their business for growth, both to make acquisitions and to expand the acreage and the level of orchards that they had. Their focus was to do it in the least dilutive way. So they wanted to give up the least amount of equity. So we helped the company speak with a number of investors and ultimately brought in an investor that, if I go back to here, was not a senior lender, but was also not a private equity firm investing in preferred equity or common equity. It was more of a junior debt type of investment where they gave up very little equity and left a lot of upside for themselves, but also paid a higher interest rate to incentivize an investor to come in and de-risk their business on a go-forward basis. Gassen, do you want to quickly take this this polling question?
Sure, yeah. Obviously, sellers typically have, or capital raise seekers have some concerns typically when contemplating a transaction. So we would like here to gauge some of those potential concerns. So this question is, what are you most concerned about with raising capital? Option A, diluting the ownership. B, safe partner. C, taking on too much debt and risk. %, so far. So you can get it a little bit higher. Okay, it seems that the highest percentage was allocated to taking on too much risk, debit risk. Scott, any comments on these percentages? Is that what you typically see and when dealing with your
that's
fund?
right. Yeah, absolutely. I think oftentimes when we see companies looking to raise capital, they want to do it in a way that does not force them to take on too much debt or risk. And I'll just end before I kick it to Pat with my firm, Cascadia. We actually took on a minority investor last year. We raised about $55 million of capital. And the reason we did it was we saw a potential recession on the horizon. Our business, our industry gets hit hard. It's somewhat cyclical, gets hit hard in these times. And we wanted to have a strong balance sheet that did not have too much leverage on it so that we could take advantage of opportunities that would come our way, potentially in periods of a down cycle within our business. And so, Gassen, to answer your question, our firm, we did the exact same thing. We took on a lot of equity capital so that we could de-risk, de-lever our balance sheet, and head into a potential down cycle in a position of power and strength where we could ultimately grow through it when our competitors may not be able to. So again, a good example of why one may want to take on this type of capital. Maybe with that, Pat, I'll kick it over to you to talk specifically about AGR and how you fit into this.
Yeah, thanks, Scott. And like Scott mentioned, there's a lot of different types of investors. And so this is a flavor of one aspect. I would say even within that, we tend to be fairly flexible by nature. So we cover a couple different buckets in a way that may not be typical. But I'll give you a quick overview on AGR Partners, as well as some case studies to help give some flavor on what situations might call for bringing in a minority partner and what that can look like to hopefully illuminate what might be most helpful for each of you. So AGR is a dedicated food and agribusiness investor. We've been around for 10 years. Originally, the fund was formed to truly be a flexible, solution-oriented partner for food and agribusinesses. And so we very much take that partnership approach. 14 of our 16 investments are non-control or minority capital. We can do majority in the right situations, but really it's more about finding the right solution and matching the need of the business with what that solution looks like. So we've got a team based out of Davis, California, and Chicago, where I'm based, and we've invested over $700 million to date with 16 different partners and manage $1.1 billion in capital. And we're pulling that out of our growth equity fund, where we're typically investing in the business itself, as well as an ag infrastructure fund, which is more asset-heavy opportunities, which obviously for food and ag world is familiar territory. The unique wrinkle for us, despite the fact that we'll do both minority and majority investments, is that we're very flexible in terms of how we structure it. We'll do common equity, preferred equity, or sub-debt. So as Scott walked through what those options are, we effectively will look at any of those three dials and kind of can turn and adjust those to fit what the need of the partner is looking for. Understandably, there's typically a desire to minimize the equity dilution, but additionally, we don't want to overburden a business with too much debt at too high of a rate. And so it's trying to find the right balance for what that business calls for in that particular situation. Similarly, we're a bit unique in that we are a long-term partner, very much intentionally made and have alignment with our investors to hold for a long run. So we can hold for 10 plus years, which is a bit unique, but very much intentionally because we're all aware of the cycles that the food and ag world can go through. And several sectors are working their way through that right now. And so that's a situation where we're not scared off by that. We are aware that when you're at a low, there's certainly going to be a peak coming through on the other side. And so that timing there allows us to invest with our partners and find the right situations to come in, and likewise the right off ramps. And so whether that is ultimately selling back to the original owners, helping them to a strategic exit if they're looking for maximum value creation, or if we're looking to create some other off-ramp or kind of a continual hold as partners. So very flexible in what that looks. And then the value add piece, which was also touched on, is, and one of our coworkers here has a great line that I love where he says, we're humble enough to know that we're not experts in any given sector way the business operators are, but we're arrogant enough to think that we can provide value to any of the businesses. And through relationships, industry knowledge, general consulting, banking, private equity playbooks. Our goal is to help fill in the gaps and support the business to achieve their optimal outcomes, whatever form that ends up taking. So the other angle here I wanted to just touch across is we partner across the value chain. So while we are food and ag dedicated, we'll start at crop inputs all the way through products. We generally stop where it is on the consumer, restaurant, retail side, but we are best served for middle of the value chain, asset-heavy businesses. And again, it takes a little bit more of a unique angle versus someone who might be, call it a private equity investor looking at software. Just a very different business model and understanding, and so that's where we have our focus. But the way we think about it as we're trying to partner with businesses is we're trying to help facilitate where there are three key moments within a business. Sometimes these will come in conjunction. The ideal outcome is always, hey, we're looking for a partner to drive growth. And whether that is a greenfield project, M&A, expansion of a facility or production and equipment, anything to help drive that growth where they may not want to overburden their balance sheet with too much debt, we can be a great partner in those situations. Some of our examples below, and I'll dive into a detail here in a little bit. Likewise, oftentimes coming in where there's an ownership transition. Sometimes that's liquidity to a minority shareholder or someone who's looking to get out, but the other partners are looking to stay in. We can help facilitate a minority owner becoming majority owner, management buying out ownership, transition of generations and buying out, for example, cousins to consolidate. Whatever form that takes, we can help facilitate that, often in conjunction with the growth plan. So oftentimes we want capital to help not only help buy out owners, but really ultimately drive growth and take the business to that next evolution. And then the third, we kind of call it's a catch-all for special situations, but where there is some level of distress or trying to reduce their debt, oftentimes due to an ag cycle, weather or margin related. And we'll also look at corporate carve-outs where it's a non-core asset. Typically a little bit more complicated, but certainly one where we can partner with someone as they're looking at divesting an asset and bring that into a family ownership group. So with that, I will call out, and I'm not going to talk through every example on these next couple slides, but wanted to call out a couple in terms of adding a little more color at a high level for what the situation called for, in that it might so help all of you kind of better understand what our angle is. So in terms of this growth aspect, Shell Rock was one where we partnered with Mid-Iowa Cooperative, and then had Phillips 66 was a part owner and some local soybean producers, but it was for $320 million greenfield soybean crush facility. Again, this is where we were a minority partner, trying to help facilitate the right relationships, the right groups, builders, engineering, to all collectively be pushing this forward. But again, where we were very much viewing it as a partner is not us dictating what has to happen. It's more so trying to bring the right experts from the ABCDs to help drive the board, the management team, and bring it all together. And again, very much a strict growth orientation. Another one that is fairly relevant here is for 3D Corporate Solutions. This is a pet food ingredient business that's in the Southeast. And we came in to be the growth capital partner for a greenfield JV that they had with an integrated poultry producer in Amex, South Carolina. And this was one where we had sub debt that we leveraged with the warrant. So can always have some element of equity, but again, doesn't have to be overly dilutive. We can add in some type of a sub debt or preferred equity structure so that it is not overly dilutive to the ownership group. Ultimately, it's more about providing the right capital, the right amount of capital to help provide the right solution for that partner. Now, on the ownership transition, again, not uncommon in food and ag. SEMO Milling is one of our longer investments. We've held for over 8 years now, still actively holding. It's a dry corn mill in Missouri. And it was a situation where it wasn't the right time for the majority owner to sell the business outright to a strategic. He was getting strategic interests and just wasn't getting it at the right valuation that they were expecting. And so we helped come on as a minority partner, helped the existing minority partner buy out the majority partner so he could maintain ownership. really the capital not only helped buy out the other owner, but then had some capital to drive growth within the business for some CapEx projects that they're looking at. So it was very much one of those things where, not that timing the market is anyone's expertise necessarily, but to Scott's point, the valuation may adjust over time, and you want to make sure if you're looking for ultimately a full sale transaction, trying to time it where you're getting the most value out of that and you're not succumbing to a cycle or a large strategic that's coming to pick you off at the right time. We can help support that transition and ultimately for the minority owner to help dictate when that is going to happen. The last situation I'll call out here, more of these special situations, but for Titan Farms is another successful one for us. We came in and it was after a peach farmer in South Carolina had built a new facility and had the once in a generation freeze where he lost his peach crop right as the facility was coming up and running. We came in to help half his debt and really rebalance what they were looking at, de-risk it, more of a structured sub-debt with some equity to basically help him through that cycle. Ultimately, he was able to double revenues over about 5 years. And we just got recapitalized out as he bought out our ownership stake by using the debt to recapitalize the whole business, and again became back to 100% owner. So not uncommon for us where we will come in, help through a situation, whether it's a growth step change, it's an ownership transition, or if there's a cycle or a weather incident where there's some support that's required. But half the time we end up selling back to the same ownership base. Similar with a corporate carve-out like Opal Foods, where we carved the Mohawk egg business out of Land O'Lakes. We were working with 2 other farmers and ultimately sold back out to those 2 farmers after we were able to work through the carve-out over several years. So generally speaking, and again, this is a part where I want to call this out in particular, is there's a lot of different flavors of investors. We're a little bit unique in that we'll cover that sub-debt on through common equity. There are others that have very much a majority-only focus, a shorter timeline, which might be the more traditional private equity some think of. There's others that are very focused on the structured mezzanine, but it's getting very fluid in today's environment with different funds and groups understanding that there are a variety of options at the disposal of an owner, and it's really about finding the right solution for what that business calls for at that time. And that's where AGR has really been focused and oriented to, is how can we be the best partner for that business? How do we get aligned on what the strategy is and how we can really accelerate and drive that to be a success? The structure comes secondary to that. So whatever form that takes between sub-debt or equity, it's more so around what the business calls for that's going to help it get to that next level up within their growth trajectory. And then I'll just kind of close out here where this is a framework we bring. So as I mentioned, we really want to be value-add partners. Every business calls for different pieces. Some of them have been, run from a very scrappy entrepreneurial mindset, and we're trying to help them bring it up to more of a corporate orientation as they continue to scale. Others are well in place. Some don't have any board governance. Some are highly structured. It's really more so what is called for in each case, but we have a playbook that we call from for where we can drive value initiatives to drive material value, where we're not just cutting a check, but really helping drive the business to be more successful, whether that's on a culture, execution, people orientation, or on the more traditional financial elements of driving revenue, improving margin, how do you optimally deploy capital, stage gate where you're doing CapEx projects, and being as thoughtful and intentional as you can as a collective group. And then this is just a quick snapshot of some of our different investments over the last 10 years, but certainly looking to do more of this type of work. And I would say at least what we're seeing come across our desk right now is a much wider variety of situations where debt was extremely cheap the last several years. It's a different cost of capital today. And I think that's where our goal is to help provide the right solution for businesses, whether they're going through some level of distress, higher interest rates, weather cycle, or if they're trying to capitalize on what might be a depressed market. And as they're seeing opportunities to bring in bolt-on acquisitions, look at greenfield projects to lean into the upside and potential within their industry. So I'll take a pause there. I know that we were going to look to make sure we left plenty of time for questions, but I appreciate the opportunity to talk to you all.
Thanks, Pat. I really like the case studies there. That shows, the reason why we picked you guys to present this, the flexibility and the creativity in doing deals and being flexible with owners. Pretty good options there. We have some, few questions here from the audience. The first one that I have is, are buyers pretty much actively looking and eager to get deals done in right now, or maybe in the next 6 months, or are they taking their time? And this applies, I guess, to both buyers and sellers. What do you guys, Scott and Pat, are seeing in terms of the urgency in doing deals with your current context?
Yeah, maybe I'll start, and Pat, happy to, would love your perspectives. But I would say the answer is it depends. There are some funds out there that I think have deployed enough capital, or maybe they do not have the fund dynamics. Think of a family office where they have to return capital at a specific date. I think generally speaking, those funds are opportunistic. If the right opportunity comes, they absolutely would like to deploy the capital, but they're not going to invest just for the sake of investing. There are other funds that I think genuinely have capital that they need to invest and return, and those funds are being a bit more aggressive in deploying that capital and making investments today. But I think investors continue to look at opportunities throughout the country as active as they used to. It is kind of a case-by-case situational basis in terms of which investors are getting aggressive today.
I would agree. I would say the deal flow is just different. I think the value expectations have come back down a bit. Others are happy to patiently wait for when is the right time to sell their business. And so it's more so that every situation is going to have its wrinkles, and where is the investor base comfortable with that particular situation? There certainly seem to be more groups that are having a more diverse array of options at their disposal from an investment perspective. So you'll see equity groups that are now looking at having debt-like options and being more flexible to meet the need of those opportunities. But I mean, at a bigger picture level, I think Scott's charts earlier on the amount of dry powder within private equity really can't be ignored and is supporting the valuation expectations. Now, outside of food and ag, I think that is certainly the place. Within food and ag, there's always a wrinkle is that it's not easy to fully understand all the time. And every sector within food and ag is unique and different in their own right and going through their own cycles and facing their own dynamics. And so it takes typically a unique partner and investor to understand what those dynamics are and how they're playing out and how they fit what you're looking for. And I would say there are certainly businesses that are being more patient as they look at those opportunities. And so strategics are looking to grow. We've got mid or large size. I would say they are more patient on should we be pulling the trigger on a greenfield project when costs have gone up 30, 40% in the last couple of years, but we're not seeing rapidly improving margins to sustain what that CapEx profile looks like. Similarly with acquisition targets. So I think there's just a lot more caution and thought being put into what opportunities are there and how they present themselves. But I would also say food and ag is perhaps a bit more unique, that from the investor environment, we all play in our sandboxes relatively well because it's far too frequent where a deal might not fit your particular parameters, but it does for your neighbor. And so we're happy to pass deals, good deals to the right groups that can really be the right partner for that business. And likewise, it's the same with commercial lenders, auditors, attorneys. It's all about really playing this as a team sport and how we find the right solution for that business to drive growth. And I think that's one unique part within food and ag, both from an investor and business perspective, is there typically is a higher calling about what we're doing, a bigger mission-driven statement around helping feed the world more sustainably. And so I think within that creates a better investor team sport dynamic where we're all trying to help find the right partner for the right solution, especially in an environment like there is today, where there's, like I said, a bit more wrinkles on every situation. It's not all cut and dry.
Thanks, Pat. Another question is, in this environment of higher interest rates, what would be the more preferable, I guess, options, debt or equity?
Scott, I'll let you answer that one first because I'm going to have a bias, obviously.
Yeah. I think the answer, and I hate to say it again, is it depends. It's very situational to your specific business. But the way I think about it is, if as you go through a period of rising interest rates, that cost of capital, that cost of debt continues to increase, and therefore the risk that you put on your balance sheet can grow. I think the usage of debt is a very good use of capital and form of capital within reason. And generally speaking, that's not for acquisitions and for growth. Oftentimes, I think equity capital presents a better use and form of capital for growth and building true enterprise value and equity value within the business, especially in periods of rising interest rates and uncertainty where there's more macro risk on top of adding debt to your balance sheet and having more business risk. So it is situational. I think debt is a great form of capital, but equity, in my opinion, tends to be better utilized for growing your business and maximizing value within using debt within reason.
Yeah, I would just add the within reason is the key piece there. Every business is different, but even within each business, every year may look a little bit differently. And so how well protected is your margin? How much room for error is there? If you are in a low margin, tightly run business, and there's an S&D dynamic that can swing at the drop of a hat, it would make me nervous about taking on too much debt due to the covenants that Scott had brought up. And so I would say it certainly depends on the situation where you have the room for error to bring on that kind of debt. If you're a well-oiled machine, you can take it on. It can be a great option. The other piece that can sometimes not be fully appreciated on the equity partner is what is the value that they can provide and what are the holes that they can help plug in that interim growth phase. And so if I think about growth in a stair-step approach, and I'm going from 10 million EBITDA to 25 to 50 to 100, those all inherently bring on different challenges for a business. And so who is the right partner with the right skill set to help you weather through that, to make sure you're coming out on the other side stronger and to get there as efficiently as possible.
Mm-hmm. Yeah. And with just 2 minutes left, I actually, Pat, I had a question for you that's going to be very difficult to answer in 2 minutes. But the first thing I'd say, less of a question, is oftentimes when we're meeting with a business owner, every business owner that's looking for capital says, I want a minority investor that takes zero control, that's completely passive. And the first thing I'd say is it is very rare. There are not many investors that are as flexible as Pat and team are, AGR, in terms of being able to do minority. Most investors like to take control and full control of the business. So just even finding an investor that will do minority can be challenging. I think that's one of the unique values that AGR brings. But can you talk about, I think sometimes business owners can have the misconception that a minority investor means they have no control in the business. I think the reality is, at the end of the day, minority investors will have minority rights that can equate to some level of modest control. I think it's important maybe for some folks to just understand that and hear that, because minority does not necessarily mean zero control. And maybe talk a little bit about that just in the last minute we have.
Yeah, and I would say certainly it depends on the situation, but typically we'll be taking on board seats and some governance rights. We will not individually be taking on management decision-making level on a day-to-day perspective, So I would say we're trying to help be supportive and have rights at a board level. But again, we are not dictating what has to be done. That being said, for us, the key piece when we're talking with partners is alignment up front and understanding what's the situation of the business today, what's the strategy to get to that next level, and how do they view that path. And if there's alignment on what that looks like and how we can help them accomplish that, then we're well suited. A lot of owners of businesses have built it on their backs, and it's not so easy to bring in an outside partner. And so understandably, it depends on when is it the right situation for them to bring on someone else? Are they ready? And do we have kind of the right mesh and understanding and view of the business moving forward? And so it certainly depends, but I would say it's a critical piece up front to just get aligned on what the vision of the business is, and are you ready to bring on a partner and have an open dialogue? But we very much take it as exactly non-control. We're not dictating. We're trying to be supportive of achieving the vision and being a partner and keeping an open dialogue as we work through that.
All right.
Awesome.
Thank you very much. I think we're out of time here. So really great discussion here we've had. So appreciate the insights from both of you guys, Pat and Scott. Thank you so much. And also thank you for our audience. Hopefully we've added some value to help you in your decision making. So thank you all and have a great day. Take care.
Thank you, everyone. Thank you, Gassen.
Thank you. Take care.
Bye.